Hello and welcome to Insights from the PM's Desk. I'm Justin Plouffe, Deputy Chief Investment Officer for Global Credit at Carlyle. Today I'm joined by Jason Thomas, Head of Global Research and Investment Strategy for Carlyle. Jason, thanks for being here today.
Thanks for having me.
So Carlyle owns more than 200 portfolio companies, and we have more than 1,000 lending relationships. This gives you a lot of proprietary data to look at. What is that data telling you about the macroeconomic environment today?
Well, the economy is in pretty good shape, I would say. First, we have this enormous rate shock that really no one could have anticipated. And I mean that very sincerely. If you were to go back just 3 years ago, the chance that base rates would be over 5% was priced by markets at less than a 1 in 1 million probability. So given this shock, you could say the economy is doing exceptionally well. First, you have households that have 70% of their liabilities are long-term fixed rate mortgages. So it's not impacting household cash flow. They're stable to spend with the increase in their incomes. Now it's more expensive to finance durable goods like autos. So what you find is that the relative price of current expenditures, going out to eat, travel, tourism, is a little bit lower. And that's really where the strength is. Those spending categories we call experiences are up about 40% relative to comparable weeks prior to the pandemic. The second big issue that we see is just this enormous fixed investment boom in the United States. And it's really the construction of industrial facilities. So, you have industrial policy, so this subsidies delivered through the tax code to support things like renewable energy, where there's 63 gigawatts being added in solar and storage to the grid this year. You have 30 battery plants that are under construction, also support for semiconductor fabrication plants. And then you have AI. And the boom there is really related to the construction of data centers. And this is also expected to grow at something like 60% over the next 12 months relative to 2023 levels. So all that's very strong. And then, of course, you have a very large budget deficit. And the counterpart to that is the surpluses of households and corporates, where their after-tax income is about $1.5 trillion larger than it would be if you had a debt stabilizing fiscal policy. So when you add all that up, it's an economy that continues to grow and again, reasons for optimism moving through the end of the year.
So against that really strong backdrop, the market seems to be changing its mind daily as to whether the Fed is going to cut rates sooner or later. What's your view on the Fed's outlook for 2024?
Well, I still think the Fed would like to get 1 or 2 rate cuts in this year. And they have several more meetings, and we'll see what happens. But I think the big change this year is not about just rate cuts being pushed off, but a reassessment of how much space really exists to cut rates. And 6 months ago at the start of 2024, people really thought that rates were going to quickly converge back to very low levels that prevailed prior to the onset of the pandemic. People are expecting terminal rates, or the average for short-term rates over the next 5 or 10 years, to be as low as 2.5% or 3%. Now that's been revised up to 4.25%. So I think that's what's more interesting to me, that there's a general sense that maybe there's only about 100 basis points of cuts in terms of the space the Fed has. And that, I think, is changing the relative dynamics in terms of fixed versus floating, and just what people can expect going forward in terms of finance costs, and also, of course, the relevant finance mix between, again, fixed or floating.
So last year, private credit really stepped into a lot of places that were traditionally bank-focused sectors. This year, banks are back. They're much more active. How do you think about that relationship between the banking sector and the private credit universe?
Yeah, I mean, it has been a fascinating year to see that many months the origination volumes in the syndicated loan market had been approaching all-time highs, and I think when people thought syndicated lending was dead, when private credit was the only game in town, this has come as a big surprise. To me, the key takeaway from this experience, it's one thing to disintermediate banks from their assets. That can and will continue. This is just a long-term process. Traditional banking, taking deposits, making loans, it peaked in the 1970s. So this is not new. But certain private credit, it's not just disintermediating banks from assets, but disintermediating them from their customers. And this is significant because the banks derive so much of their income, in some cases, the large banks, 85% of their income, from non-interest sources, essentially fees. So as you step up above certain size threshold, maybe it's 400 million of EBITDA, but those companies, you're starting to get into really the most lucrative clients because they may be IPO candidates.
Right.
They may be acquisitive, so there's M&A advisory fees. They have need for transaction services, interest rate, FX hedging. And it's those customers that the banks are inclined to really very jealously guard. Mm-hmm. And that's where I think the competitive pressures have really manifested themselves this year, again, above a certain size threshold.
So as you look out for the rest of 2024 with a higher for longer view, where do you see the best investment opportunities?
Well, I think that there's still a reckoning in store. And that really relates to capital structures that were assembled in 2020, 2021. As I said at the outset, when rates were expected to remain low indefinitely. And during that period, of course, purchase prices were extremely high. So to pay 18 or 20 times EBITDA for a business was actually quite common in technology, software, also medical technology, other related services. And in those cases, it was also quite common to put 7 to even 9 times debt on those companies because that was actually a very low LTV loan. I mean, in some cases, you would see this massive equity buffer sitting below you. It's 35% LTV. It's like, well, maybe the interest coverage could be compromised, but, rates are going to remain low, so we don't really have to worry about that. Now, given base rates, given the margins, if you're 8 times levered and you're paying 10 or 11% interest rates, all of your operating cash is going out the door to pay your creditors. For these companies that are fast growing, they need that money to invest, to pursue their growth opportunities. So I think that there's many sponsors and other owners of businesses that will recognize that this capital structure just doesn't make sense. The value of the company is going to be less in 3 years' time because it's not able to pursue the growth. And they're going to seek out essentially private credit to come in a junior capital role, defer some interest, get some warrants or options to participate in upside. Mm-hmm. And again, I think the opportunity is very large, and it's just the expectations of rate cuts, the idea that the Fed was going to solve their problem for them, has actually delayed what I think is going to be, again, a very big opportunity.
I think companies are figuring out they need to solve the problem themselves with their partners and not wait for the Fed. Jason, thank you so much for your thoughts today. And thanks to all of you for tuning in to Insights from the PM's Desk. We'll see you next time.